Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Rick Martin. He founded Fortress Federation Investments, a private equity firm investing in value add multifamily assets in Texas, Florida, and Arizona. And they align with experienced operators in fundamentally sound markets to create optimal partnerships for their investors. They handle the entire process from sourcing to acquiring, managing selling properties so their investors can enjoy stress-free long-term financial growth through monthly cash flow and asset appreciation. So thank you so much for coming on the show today, Rick.
Thanks, Charles. Thanks for having me, man.
So Rick and I know each other from a mastermind group, probably over the last year or two, and I thought it'd be great to have Rick on and have him tell us his story and his words of where he was and where he is now. So, Rick, if you can give us a little background on how you got into real estate investing, a little bit professional and personal before really doing what you're doing now.
Yep. Pretty common. I didn't know much other than just buying a house to live in, and that was the plan. I wanted to buy a house. I was living in Seattle, Washington. Had been graduated from the School of Business out at the UW, and just following the normal blueprint. Where had a lady in my life. She's not my wife now, but we were talking about buying a house together. That didn't work out, but I continued down the road of buying a house, and I did, but life took a change. I sort of had a career change where I wanted to get into something a little more creative than what I was doing business wise, and rather than selling that place, I put it up for rent. And didn't go too far away. I went up to Vancouver, British Columbia, not too far from Seattle, and had that place rented. And it was, I was finding out that it was quite helpful, having those rent checks coming in as I was a broke student. And that was like during, going to school, which was further education. I was like, this is pretty cool. It was different than my stocks. I was getting cash flow. And so I kind of thought I'm going to do this on the side as a side hustle, and that'll be part of my retirement. Um, Ended up moving down to LA from Seattle, or after that school stint, and continued to invest in places like Las Vegas, Palm Desert, California. Went through tough times, 2008, where I thought they would never come back. And really was questioning, do I really want to be in real estate at all? This is brutal, but it was just part of that learning experience. Like, hey, you go through valleys, and you can get out if you stick with it. And thank goodness I did. But I was, in terms of what I was doing, I was so I backing up. I went to a film media school up in Vancouver, and that's why I moved down to LA, because everything in the post production field in terms of production for entertainment was down here in Los Angeles. And it was creative, exciting times, but it did become a grind. And somewhere along the line, I thought, I want to transition full time to real estate, and eventually that's what happened.
So when you how did you continue your real estate investing journey after making it down south and with what you were doing? How did you kind of restart into it? Because you already had a property, you already rented it, and it's really getting into that first, really, getting into the investment properties. What were the first ones you did?
The Vegas properties were actually was just word of mouth through some of my colleagues. Vegas was hot at that time. This was previous to the last recession. It was. I remember, I had like 100 grand in equity my first year, and that was a lot. Back then I was like, wow, man, I'm gonna be rich. And meanwhile, my Seattle property was growing by leaps and bounds, and I really felt like I was on a great trajectory. And um, you know, after after the recession occurred, I think that first Vegas property I bought, it had been up to, I don't know, 350,000, which was a lot at the time. I think 2005 or whatever, and then it was worth like 75K. So I was licking my wounds, but fortunately continued to network. This was before bigger pockets and all that. Just kind of networking with some friends, really, just some surf buddies that were involved in real estate, and we started doing some we doubled down. It was time to buy. Although getting capital was really difficult. Getting any kind of loan was very capital or very difficult. And so we were, at first we were coming out of pocket, but then we started to partner with people, and those are my first tastes of taking on private investment in some of these. We were buying like duplexes, some single family. Um, and I think while me and my wife were looking for another residence to buy down here in Los Angeles, that's finally when I caught wind of bigger pockets. And that kind of opened up my world to, the entire country. And then I started investing in small multifamily in the Midwest, in Indianapolis. Um, Got into a small apartment in I think it was 12 units, I want to say. And it was, it was going okay. Thought I wanted to operate on a larger level, and ended up partnering with someone who had experience running these huge properties, which I didn't know was even a possibility. But he was a grizzled vet. He was buying something in Columbus, Ohio, and that was my first taste of syndication. And once I got on that scale, it seemed just to kind of make sense and just stick with that. So couldn't do it all myself. And you're well aware you have to partner with others. It's very handy to have boots on the ground, which I do in the markets I like. Um, Down, the Texas market's very strong. So I got a good team down there. Work with a team in Florida, and work with another team in Arizona. And those are kind of my primary markets now.
So, with having your markets and what kind of deals, give us a little background on really your current investment strategy and the deals in those specific markets that you really focus on, you and your investors.
Yeah, sometimes I'm tempted to get into a new development deal or maybe a build to rent deal, but the tried and true value add multifamily formula is what I stick to, and that only means we don't go too old. We go about mid 1980s and above, garden style, 200 units plus. Um, and we generally look for deals that have good, like the boring infrastructure in place, like the wiring is sound, the plumbing is sound, the roofs are sound. So we don't have to like sink a bunch of money into that because you know tenants, they don't really care about that. They want to see nice vinyl flooring, nice countertops, all the finishes, so we can spend the money on the stuff that improves the curb appeal. That's one criteria that we stick to. And these markets that we invest in, they're mostly primary markets, but we do have a few secondary markets as long as the fundamentals are strong. There's some strong trends in terms of population moving there, and business friendly business environment, a diverse economy. It's not just military, not just oil. There's a lot going on there. So those are some of the things we look for.
How have you effectively pretty much formed these relationships with deal operators and sponsors? Because that's a question for active investors who are doing syndications like you are, and then also for passive investors as well. They're going to have the same questions of how they really found people to really invest with down the road.
Yeah, I think a good thing to do is get out of the house and go to meetups. One of the partnerships that I have, I actually is it lives fairly close by, and we wouldn't have met each other had I not attended a meetup, and we just started getting to know each other that way. We never even really even thought at that time that, oh, we're going to work together. But you get out, you start building your network, and you'll be surprised at what comes your way. And that can be done online as well. I'm thinking of one of my partnerships, my longest tenured partnerships. It just started with a phone call, and I believe, I can't remember who found who, but one of us found the other on LinkedIn, and then we had a Zoom call. Then we had another Zoom call, and you know we became very comfortable with each other, which you know that that that's a criteria I have. It's like I have people approach me. Would you like to come in on this opportunity that we have? And it's like, whoa, wait a second. This takes a while. Um, I really I take my time. I watch them for a while. I evaluate what they're doing before I can get comfortable actually partnering. And then I would lastly say referrals. And that kind of goes hand in hand with building your network. You're going to get referrals. So yeah, going out, meeting people in public, reaching out to people online that you meet, whether it's through Bigger Pockets, LinkedIn, Facebook, however you find them, Google, um, or just, taking a good referral from some referrals are worth a lot.
Yeah. No, that's really important about what you said, because I find it very interesting is that we'll have people reach out to us to raise money for deals. And I had someone, I just remember, as you were saying, about like a month ago. And I was like, all right, well, send me out, I'm not going to partner on this deal with you. Send me out like your track record.
Ah,
Nothing. You know what I mean? Like, so it's really just it. I mean, that all sorts itself out for the most part, but people are just, they don't care about a real relationship. They need money for a deal, and that's all they care about. They don't care about, oh yeah, in the future. And I've had it multiple times, even within different mastermind groups I've been involved with too. You know what I mean? So it's just like you find people and they just don't want to. I don't know. Just it's just not going to be a fit. So it's really important, I think, that, like you said, to really build that relationship. And referrals are the best. You know what I mean? It's really, if you're getting a referral to someone and you trust the person you're getting that referral from, I mean, it really puts it really solidifies the beginning of that relationship.
absolutely. Yeah. Like what you said, um, there you go. They reached out to you and then they kind of showed you what they're all about by not delivering just a simple request that you had. You can learn a lot about, you just have to start that process of communicating and see how they communicate with you. If they're communicating with you, if they're very transparent, that's a great sign, and it's worth pursuing that. But yeah, I would just say take your time, be careful, um, and make sure that you have the same interests, or your interests are aligned. Maybe if you're looking for cash flow, then you don't want to be jumping in on a group that's doing new development, because you're not going to see any cash flow for a couple of years. And then just how conscientious are they of the community? Are they just in it for the buck? Are you comfortable with that? There's a lot to align yourselves with.
Yeah, the communication is a huge thing. I remember being at a real estate conference years back, and people were there. Like, somebody got on stage and was like, "How many people like get emails from deal sponsors? How many people are invested? Like, there's a limited partner right now. How many people would want to have better communication with the sponsor of the deal that they've invested into passively?" And I mean, so many hands went up. I mean, it's like a simple thing of the communication, but people don't do it, and it's like it's very difficult to get answers out of people. And that's the same thing I'd find when working with certain operators that we've spoken to or that I've heard other people work with. And it would be, you get once in a while and you're like, okay, and you'll get that feeling initially sometimes where it's like this person just needs what you're bringing and they don't really need you as a partner. And it's difficult, because especially if you have investors with you and you have partners with you and you have all these different people that are relying on you
Mm-hmm.
and this partnership you have with this group.
Mm-hmm.
I mean, you want to be in a partnership with them. And a lot of different people don't want that. They're just like, okay, I need to fill this out. And so, come along and do this, handle this. And once that's done, you know what I mean? We'll handle everything else. You don't really have a say in it. And that becomes difficult to operate a deal like that.
Oh yeah, you can't. Yeah, you have to be included in on those conversations. I'm always pushing, because if you're not at the location wherever the operating team is, you have to be included in all that, because you're the one who has to communicate all that to your investors. So yeah, you got to be in one way, shape, or another in on those asset management calls, um, and they need to be communicating to you before anyone else. Like you're right there with them. That's definitely a pet peeve of mine.
Yeah. When they've made decisions or they're planning on making decisions or they've already really made their
Hmm.
decision. And then they're like,
Yeah, you're finding out
it's,
when all the other investors. So that's not good. You got to be
yeah.
part of the team.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Yeah, there's so many things about partnering with anyone, especially in this business. You're not like we're not flipping houses, and people got really used to 2-3 years of making all this money in the deals, and now these are going to be a lot longer. I feel,
Mm-hmm.
you know what I mean?
Mm-hmm.
They're going to go for what we tell people in the actual investment memorandum of 3, 5, 7, 10 years possibly. So that's how long this relationship can last for, and so. It's really important being on the same page with every different piece of the deal. But
No doubt.
so Rick, let's just say, for example, I mean, you're a pretty astute underwriter when we speak about deals that you are looking at. I mean, and if an operator sends you a deal and to potentially partner with them on, and you're reviewing projections, you're reviewing their underwriting, what they feel of what's going to happen. What are some of the things that you think are some of the most important aspects of underwriting that maybe you focus on, whether it's throughout the whole underwriting process or like initially that you want to see? And you went over a little bit beforehand, like the number of units and the markets and stuff like that. But when you're getting like deal specific, when you're looking at that, what are some things that you pick out that you feel, because you do a lot of passive investing too? So you're looking at deals that could be active on or could be passive on.
Yeah. Well, you know, a lot of investors they'll look at the returns and they'll go, "Oh, those are nice." You got to be looking what's under the hood. So what I'll do, something does get me excited. You hear $300 under market rent. Um, that's that's a good thing. Now you just have to verify that. I really like a deal that has a good delta between current and market rents, but are those actually the market rents? And you just have to drill, whoever your sponsor is, are these actually the current rents? If you want, you can actually request a rent roll. I'm not sure if everybody knows what that is, but basically that's line by line. All the renters on let's say a 200 unit, they have, you can get an Excel spreadsheet and actually total what those current rents are. Um, and then you're going to want to verify what market rents are. The best way to do that, really, maybe reach out to a commercial broker. There are online resources like rent. I never know if it's Rentometer or Rentometer. There's apartments.com. You can just cross-reference a bunch of resources and sort of kind of see whether their market rents that they're projecting are realistic. And then I want to verify rent comps. What the closest properties, in both quality and location, what are they actually getting, and where do we fall in line with them? You know, are they looking at setting, being at the top? That's a little scary for me. I'd like to, even after renovation, I'd like to be somewhere sort of in the middle, at least up, no higher than the upper third. And then I really, I really question, okay, you're saying you're going to get to these rents. How long is that going to take? And what's your business plan? Are you really going to be renovating 10 units, per month? Is that possible? Because it's pretty easy to say, yeah, we're going to get to from this rent to that rent in a year and a half. Well, that's challenging. So, and what are you going to do with the existing units? Are you going to just up those rents? And then, you risk, sometimes you want to turn over that tenant base, and a little rent bump will do that. It'll get people moving. So I like some clarity on the business plan, like how realistic and how challenging is this business plan given the environment. Like right now, with talks of recession and the interest rate environment the way it's been, it may not be the best time to be jacking up rents, on tenants. So um, yeah, I look for sort of a lower risk business plan, feasible, feasible, attainable rents that can be achieved. And now I'm going off here, but rent growth, uh, you definitely you don't want to be seeing 5%, 6% rent growth right now. You want to be seeing, more like 3% realistic. Expenses kind of targeted right in there with them. Um, and yeah, the old crystal ball comes down to the exit cap. I mean, that one's very difficult. But you want to make sure, you just want to see, what is their exit price? What are they predicting they're going to sell this thing at? Because that really is the crystal ball, right? No one can really predict that. Um, yeah, I could go on and on, but those are a few.
Yeah, the market, and the one thing I find in a lot of those packages is I'll find that, like, your second point you put out there, which was how accurate that is, or how apples to apples, let's just say it is, because you'll find them that are farther away or that aren't even a near vintage, or
Mm-hmm.
because if you find something that's within a couple of years of each other that's fairly close to it, you know what I mean, and then you can look at the condition of the units. So I can go on to you can go onto the PL's website, figure out exactly what the size of the unit are, or you can really run your rent comps that way. But the problem is that, I think, is when you have people that are putting out things and it's not. I mean, I one time saw something and the rent comp was 3 miles away. You know what I mean? So it's like it might as well be in a different state. I mean, it doesn't hold any water of what you're going to do. So I just, yeah, rent's very important, and then also where you're pricing it. So I think that's great information. Because normally what we'll put is like, if my rule of thumb, and if I'm speaking to anybody, it'd be like 20, 25, that 30% is really where that rent has to go to really fulfill any type of business plan that's going to make sense in a double digit return. I mean, that's really just kind of how it comes down. And like you're saying, you probably want to see that even higher so that you don't have to go all the way to the top. So
Exactly.
yeah, yeah. So when you're, I mean, what does it really mean when you'll hear, I talk to all the time, and you'll listen to podcasts, you'll listen to anything, and it'll be conservative underwriting. Everything's conservative underwriting. And like you went over a couple things about what you look for when you're looking at a deal, but what really, obviously, you have that exit cap of where they think it's going to sell, where the market's going to be, where interest rates are going to be, which we don't really know. But other than that, what really makes the underwriting conservative for a deal, and something that I imagine you're editing the underwriting that they're sending you with maybe different information that you feel is more accurate.
Yeah. Probably start with the debt. You don't want to be getting into something with too high LTV. You don't want, especially right now, something like 80%. Anything above 80%, you really have to question that. Um, that's 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 sort of where I start. I mentioned, rent growth, and really just revenue growth over those first few years. If you see like a revenue growth of, teens, 18, 20% year one, those are pretty lofty aspirations, and it's going to have an effect on, just if you're really trying to raise rents, that you're going to have some occupancy issues. So achieving those revenues year one, year two, you have to look at that as a red flag. Um, yeah, and then I talked about just the exit price. It really, the whole exit cap thing is, or predicting what you're going to sell. That's the part that bothers me probably the most, because, like I say, it's just a crystal ball. So you have to project that exit cap. So you just want to see where it is at, and where it, you know purchase cap, it doesn't really matter. It's more just the prevailing market cap, and that can be difficult for a passive investor to find. You want to ask your operator, okay, what is the prevailing market cap? Hey, it's their duty to be completely honest and transparent with you. So their answer should be accurate, and they should have that either from, good data resources like CoStar or Yardi Matrix, or brokers, um, or maybe just the best thing is if you have a large database yourself and you're underwriting deals, and you have the average prevailing market cap. So I think, yeah, so those are the things you know, conservative underwriting, you just want to make sure that the assumptions that they're making are, not too lofty. So
One thing that I found with underwriting is when you're, like you said it initially, was about going through the renovation process, and you'll find that people really, a lot of new investors will really dramatically increase what they think they can do for units renovated, and they really shoot short really what they think the vacancy is going to be for that. You know what I mean? Where you're seeing like you're going to do all this to one unit, you're going to rent it and everything within 1 month. I mean, that's very aggressive. You know what I mean? So when you're looking at their vacancies, like, so you're doing all these units, but your vacancy is still this low, and all these different things, like you said, they're extremely lofty. So it's really have to kind of dig into how long these units are going to be vacant, especially now, and then how much work they're doing to them. I mean, this time right now, you might do renovating less units, you know what I mean? And just re-renting units at what the price is, closer to what it is currently. But in the future, like we were doing 2 or 3 years ago, we were doing many units per month, you know what I mean, at all your properties, because there was that appetite for purchasing them after, or for renting them afterwards at that higher price.
yeah, well, yeah, exactly. You have to. It all has to align, right? Your deal isn't in a vacuum. It has to align with what's going on in the market. You just said it. If there's a lot of competing supply, you're gonna have um, you're gonna have some vacancy. You're gonna have some soft rent growth. So it really all has to align, and that should really all be set up well for you in the investment summary. It talks about the team, talks about the market, what's going on in the market, what's the absorption rate. Are units getting absorbed? Is there market demand? Is there rent demand? That all plays into the business plan. It all has to fit together.
So you went from being a W two employee, you're now a full time real estate investor. What were some of the mind shift changes that you had to make to do that, and going from your own boss becoming an entrepreneur?
hmm Yeah, well, own boss, that's a big one. That was sort of my why. People say they're kids. Well, you can be a W-2 worker and your motivation, it's just putting food on the table, right? Um, so really, I would have to say my why was being my own boss and more control of my schedule, so I could be with my kids. Um, I I had reached burnout, I don't know, many years ago actually, and I knew that I wanted to transition into real estate. And for a while there, what I did, I left W-2 quite a while ago, and I was a contractor, basically a 1099 free agent. And for a while there, I was telling myself, well, this is pretty cool. I can freelance, in my old career, and I can do real estate. It's my new career, and I can do both. But it was really diluting my focus. I was splitting my focus. Not only was it stressful, I'd be at work and I'd have real estate obligations, but I needed to be there full time for my investors. I couldn't be, oh well, I kind of do this part time. That they require your 100% focus. So I didn't feel right splitting time. Um, and then once I did that, I did jump ship. I burned the boats. Like this is what I'm doing. I'm no longer this, but I do this on the side. I am this. I'm a full time real estate investor. This is where my focus is. Failing is not an option. This is what I'm doing now. It's gonna work. If anything, it kind of tested my mettle and my resiliency. But it's more exciting being your own boss, I think.
That's fantastic. So as this whole career you've been going through, I think since the late '90s, investing in real estate. You've been around a lot of real estate investing. We went through some of the issues you see sometimes with underwriting. What are some other mistakes that you maybe see real estate investors make that you pick up on here and there that's maybe outside of the scope of like underwriting, as we spoke about earlier?
Yeah. You mean other than, well, in terms of passive investing, I think a lot of people will see that just go off the returns and call it a
Yeah.
day. And it is good to be so comfortable with your operator that you trust what they're doing, but you should do some homework on yourself, and there are ways you and I have talked about, like we could do something educational for our communities where we can kind of show them how they can do some due diligence on their own to sort of verify what's going on, so they don't have to just take the operator's word for it. So although it is passive, you know, there's no harm in doing a little bit of your own homework, and at least ask the tough questions. Don't be afraid to ask the tough questions. Um, Other than that, I think in terms of just real estate investors themselves, sometimes it's good to have a positive mindset, but you really have to um, analyze whether your business plan is realistic. And I think sometimes people think that they can they can renovate, raise those rents, and it's all going to go perfect. And as we know, there's problems every day in real estate. Real estate's challenging. It's like something's always constantly going wrong, and that's why it's kind of nice, I think, for passive investors to be have that buffer, so they don't have to see all that. They don't have to take those phone calls, because tenants, more a lot more than others, like getting on the horn and telling what they think about what's going on with your property. So yeah, I think just not having just I guess just being able to defend the numbers, where whether you're on the front lines or you're a passive investor, just make sure those numbers are defensible.
Yeah. And I think also just seeing where you are in the market cycle too when you're making that decision, because if we little uncertainty right now, that's probably going to be you're not going to be as aggressive on your numbers because you're not going to have that market really saving you. You know what I mean? As these growing markets are great when everything's going up. When they're a little uncertainty, I mean, then you have to really. There's not anything to save you if with your business plan if you're going to go off course a little bit.
It's interesting because I almost feel like now is a much better time to invest than it was 1921 or 1921, 2021. I don't know about 90. If you
Yeah.
invest in 1921, you're probably doing pretty good with that property now. 2021, 2022, yeah, like you say, we were at the top, and it's that whole herd mentality, like, wow, the real estate's doing great, I gotta jump in. Now at least there's been some correction, and the only problem is the market's so tight now. There's not, I don't know about you, but it's quieted down in terms of deal flow. So when a good deal does come along, you should take a good look, because now is actually a time where you might be actually getting a discount on a deal, whereas you're buying at the top at 2021.
Yeah, no, definitely. I definitely agree with that. I mean, it's been tough here for us finding deals over the last year and a half, really. I mean, from definitely the last year, I mean, it's slowed down dramatically with deal flow. So it's something that we review deals, we see them come in, but really sticking to, as you said, having your criteria, knowing exactly what years you're buying property, know what markets you're buying, and sticking to that, not going into anything else kind of shiny object type scenarios and strategies, I think is really the way and the key to success.
Absolutely. Yeah, I guess it's just difficult to predict what tenants are going to do right now, and um, I guess there's still talk of unemployment rising toward the end of 24. That can have a kind of effect, and we're just going to have to see what's going on with interest rates, but we can't just depend on interest rates coming down. You got to seek creative ways to create cash flow. We've been in I've talked about some of the deals we've been doing, these tax abatement deals where you're getting huge write-offs for your property tax, and eliminating the largest line item on your expenses is just as powerful, and lower risk than trying to renovate and raise rents. So it actually aligns with what's going on in the market right now. That if there's a little uncertainty, you know, if you can reduce expenses, you don't have to worry about raising those rents, but you're still capturing that cash flow and value. So that's kind of what we've been doing.
Yeah, you're slightly adjusting your business plan a little bit for depending on where we are right now in the market cycle. So that's a great way of doing it.
Exactly.
Rick, how can our listeners learn more about you and your business?
I think the easiest thing to do is just go to our website, fortressfederation.com. On there, you can find a button to schedule a call. I love talking shop. I love hearing people's stories, and seeing whether it's a good fit for you, yeah, get a hold of me and let's talk shop.
All right. Well, thank you so much for coming on, and I'm looking forward to connecting with you here in the near future.
Right on, Charles. Thanks a lot. Appreciate it.
Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndications Superstars, LLC exclusively.